There's a war that's been raging for centuries, but it doesn't use guns, tanks, or armies. It's fought in silence. It's in ledgers. In the unseen machinery of finance. It's a war between money and real wealth. Because once upon a time, wealth meant something tangible. It meant land, crops, gold, labor, the fruits of your own work. But somewhere along the line, that meaning was rewritten, quietly, methodically, deliberately.
Oh.
Today, billions wake up each morning chasing digits on screens, believing they represent prosperity. But those numbers, those assets and balances are not wealth. They're claims on wealth, promises, IOUs issued by powers most people never see. And as the promise is multiplied, the real thing, the substance beneath them, began to vanish. What you're about to hear isn't a story of markets or economics. It's the hidden chronicle of how money, once a symbol of value, became a weapon of control. A silent revolution that changed the fate of empires, toppled governments, and enslaved nations without a single shot fired. And yet, most people never realized it happened. Our story begins long before modern finance, in the ancient marketplaces of Mesopotamia, Egypt, and Rome. Their money wasn't an idea. It was metal, heavy, solid, and scarce. Gold, silver, bronze. Each coin carried value not because a king said so, but because the metal itself was precious. In those early civilizations, wealth was visible. A farmer's grain, a merchant's caravan, a ruler's treasury, all represented physical, measurable assets. When people traded, something real changed hands. Trust came from weight and purity, not from policy or politics. And yet, even then, seeds of manipulation were being planted. When rulers discovered they could debase their coinage, mixing precious metals with cheaper alloys, they realized a dark secret. They could create more money without creating more wealth. Rome perfected this deception. By the 3rd century AD, the once mighty denarius, once pure silver, was barely 2% metal. Inflation soared, trade collapsed, and Rome's economy rotted from within. What began as an empire of gold ended as an empire of illusion. The pattern was set. Every civilization that learned to separate money from real value eventually paid the price. Centuries later, as trade networks expanded, carrying heavy coins across continents became a burden. So merchants invented a new instrument, paper receipts for gold stored in vaults. These receipts were convenient, portable, and supposedly safe. They could be redeemed for gold at any time. But soon, bankers noticed a peculiar thing. Most depositors never came to claim their gold. The paper itself had become trusted. And that trust, that faith, was exploitable. The first fractional reserve practices were born. Goldsmiths realized they could issue more paper claims than gold they actually held. As long as not everyone asked for redemption at once, no one would notice. It was a clever trick, a quiet alchemy. Money was no longer the thing of value. It was the claim on value. A subtle shift that would reshape the world. By the 1600s, entire banking systems emerged on this principle. In Amsterdam, London, and Venice, paper began to eclipse metal. Credit replaced coin. And for the first time in history, private banks gained the power once reserved for kings. The power to create money out of nothing. England, 1694. War with France had left the crown nearly bankrupt. The monarchy needed money fast, but the royal treasury was empty. A group of wealthy merchants proposed a solution. They would lend the king gold, and in return, they would receive exclusive rights to issue banknotes, backed not by gold alone, but by the government's debt. Thus was born the Bank of England, the prototype of all modern central banks. Its genius was simple. It transformed debt into money. When the bank loaned to the government, it created new notes, claims on the future, disguised as currency. The more debt the government took on, the more money entered circulation, and every note in a citizen's hand represented someone else's obligation. A quiet war began that day between real wealth, produced by human effort, and financial power, created from promises. From that point forward, nations would fight wars not only on battlefields, but on balance sheets. The 18th and 19th centuries saw revolutions in trade, science, and empire, all funded by one thing: credit. Railways, factories, colonies, financed not by savings but by loans. The expansion seemed unstoppable, as long as credit kept flowing. But credit is not wealth. It's a shadow of wealth, pulling consumption forward from the future. And every boom built on credit carries the seeds of its own collapse. The crash of 1873, the panic of 1907, the Great Depression of 1929, each was a symptom of the same disease, the widening gap between money created and real wealth produced. Yet each crisis also brought greater centralization. Each collapse strengthened those who controlled the money supply, because when people panic, they look for saviors. And the saviors were always the same institutions that had caused the crisis in the first place. By the late 19th century, nations sought to restore order by returning to a strict gold standard. Under it, every paper currency was tied to a fixed amount of gold. The promise seemed simple. Money would once again represent real value. For a while, it worked. Trade stabilized, inflation slowed. But the system had a flaw. As industrial economies grew, so did their need for money, and gold couldn't keep up. The supply of real wealth was finite, but the hunger for expansion was infinite. So governments and banks quietly began to cheat. They printed more notes than they had gold to cover. The illusion of stability held until the First World War. When the guns began to fire in 1914, the gold standard collapsed almost overnight. Nations suspended convertibility, printing mountains of paper to fund the slaughter. For the first time in modern history, human lives were priced in inflation. In 1918, Europe lay in ruins, but the financial elite had discovered something extraordinary. War was profitable, and debt, once a burden, had become a powerful tool of control. Out of the ashes of war, a new system emerged. The United States, largely untouched by destruction, held most of the world's gold. The dollar became the new anchor of trust. In 1944, in a small town called Bretton Woods, global leaders gathered to design a new monetary order. The world's currencies would be pegged to the dollar, and the dollar would be pegged to gold. It seemed like a return to sanity, a balance between money and real value. But behind the scenes, a familiar pattern was already forming. The U.S. soon realized it could issue dollars far beyond its gold reserves because the rest of the world needed those dollars for trade. Once again, promises outpaced substance. Money became detached from reality, and nations built their prosperity on a growing mountain of paper claims. The war between money and real wealth had entered its most deceptive phase. Narrator somber tone. By the mid-20th century, humanity had achieved technological miracles, but its foundation was an illusion. A world built on paper, debt, and trust in institutions too powerful to fail. The question was no longer what money was, but who controlled its creation. And soon, that control would shift again in one night, in one decision that would change everything.